Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments, and here's what's in my weekly column. Well, this week has seen the FTSE 100 index, which contains the 100 largest companies listed on the UK stock market, soar to new all-time highs. Earlier this week, the index touched 7,531 points, and in the past 12 months, despite much political and some economic turbulence in Britain, the FTSE's gained roughly 20%. But why? Well, the latest surge on the London Stock Exchange was mainly due to increased oil and commodities values and a weaker sterling. The price of crude oil rose after OPEC, the organisation of the petroleum exporting countries, was reported to have extended a deal with Russia that involves limits on oil production levels. A reduction in the supply of oil typically translates into higher oil prices, of course, and at the same time, the price of precious or valuable metals such as gold, silver and copper improved. When it comes to sterling, as we saw in the immediate wake of the UK's decision to leave the EU last June, when the value of the pound falls, the FTSE 100 has risen. This is because so many of the UK's largest companies derive their earnings from overseas, so they're worth more when sterling falls. Also in the UK, inflation has rocketed to 2.7%. That's well above the Bank of England's 2% target. According to the Office for National Statistics, the main driver of this latest increase was a rise in spending on airfares compared with 12 months ago, and this was due to the fact that Easter fell in April this year as opposed to March in 2016. High inflation and record low interest rates are a disastrous mix for savers, who now have almost no chance of getting a positive real rate of return on cash held on deposit. Under other circumstances, rising prices might lead policymakers to hike interest rates in order to curb consumer spending, but given the current Brexit-related uncertainty, there's little prospect of the Bank of England choosing this course of action. See you next week.